I think they're going to do broad-based unilateral tariffs. There's going to be escalation. I think your baseline has to be that they're actually going to do this, and there's going to be pretty negative impacts on the economy. This idea that Trump is like a pro-markets force, I think, is quite backwards, and the markets are going to come to understand that over time.
I am joined by Benn Eifert, managing partner at QVR Advisors. Ben is a specialist in volatility, and we've got some volatile markets, so it is a perfect time to be speaking to Ben. Ben, welcome to Monetary Matters. How are you doing?
Jack, I'm doing great, man. Thanks for having me. This is going to be fun.
Ben, before we talk all things volatility, what is your macro view? Would you agree with me that it is Trump tariffs and news flow on the Trump tariffs that is moving the market and not really that much else? And how are you thinking about that as well as your overall outlook?
Yeah, I think very much so. I mean, I think there's a couple of things moving the market. I mean, like with anything, to really get some volatility, you usually need some crowded positioning, high gross and net leverage. You very much had that coming into this whole episode, right? You had hedge funds at like record high levels of gross and net. Everybody got the initial reaction to Trump was very positive. Everybody was very bulled up. There was this kind of narrative that he was going to be good for business, deregulation and tax cuts and everything. I think what was missing in that narrative is that actually, if anything, certainty and stability is more important for businesses than tax levels on the margin or regulations on the margin. And Trump has been very much all about uncertainty, right? Very volatile policy stances. The market's not sure how to process the newest Trump tweet or the newest Trump advisor policy pronouncement, right? Okay, are they serious? Are they bluffing? Are they negotiating? What are they doing? Is this meaningful? Tariffs have been very much that way, right? For a month plus, we've been doing this kind of cat and mouse game of like, okay, we're going to do 25% tariffs on Canada and Mexico. Okay, just kidding. Okay, yeah, we really are. They give them another couple of weeks, and I think markets have discounted a lot at this point. I think the idea that tariffs are going to be actually meaningfully implemented, I probably come down on the other side. I think actually Trump's senior advisors, you think of Stephen Moran and Stephen Miller, these are very nationalist, xenophobic, kind of isolationist guys. Stephen Moran has written a ton on exactly what he wants to do on the tariffs front, and I think they're really going to do this. I think they're going to do broad-based unilateral tariffs. There's going to be escalation. There's going to be, there's going to be negotiation. He'll drop some of them when, world leaders kowtow to him. But I think your baseline has to be that they're actually going to do this. And there's, going to be pretty negative impacts on the economy.
So you think Trump means business and that he and his team are intent on reordering global trade as they would define it, and they are intent on that mission, and they're not too concerned about the market going down a little bit?
I think Trump says he's not concerned about the market, but I think you have to call nonsense on that to some extent. Trump is very narcissistic and focused on everybody sort of celebrating him and the stock market celebrating him, right? So I think with equity markets down 10%, Trump definitely was getting nervous. But I think ultimately they do mean business. And Trump, when you think about the tariff story that Stephen Moran is pitching to Trump, it's really and in a nutshell, it's we're going to make the rest of the world pay for our tax cuts, right? Trump loves that story. That's like very much up his alley. It's just like we're going to build the wall and make Mexico pay for it, right? So he's like totally bought into this thing. And, I think you're going to actually see it happen.
And what's your view of the Steve Moran, Donald Trump vision of high tariffs, and particularly the Steve Moran view that, the Econ 101 view that tariffs are always bad is not true because the elasticity is with the rest of the world. They have to import to the U.S. is the strongest market. We are the ones with the cards. What do you think about that?
Yeah, I mean, Stephen Moran has a paper and a podcast on this. I posted a long Twitter thread about this. I mean, it's completely idiotic. I mean, Stephen Moran is a joke. And, sort of if you talk to the economics community, I think he kind of always has been. I mean, ultimately, his view rested on this kind of hand-wavy notion that exchange rates, two things. Well, first, he said that he thinks the US dollar is overvalued because the US dollar is the global reserve currency and that creates capital inflows. That's a fair enough starting point. I think, there's people who would agree with that. But then he says he wants to use tariffs as a mechanism to re-equilibrate global trade. But then he argues that tariffs are going to cause the US dollar to appreciate further vis-a-vis trading counterparties in order to offset the impact of tariffs on consumer prices. Now that's just completely backwards, because he just framed the whole argument as like, we want the US dollar to come down, we think the trade is out of equilibrium. So now he's just like completely undermining his own position in the first place. And then when you actually look at his argument that that exchange rates more or less move to offset tariffs impact on domestic prices. First of all, that's crazy. Nobody agrees with that. There's tons of evidence that that's totally not true. The evidence that Stephen Moran pointed to was literally, he just pulled up a chart of dollar China, over the couple of years surrounding Trump's first set of tariffs, and he like eyeballed the low on that chart and the high on that chart, and just sort of like connected the dots and said that that was the impact of tariffs, which is completely nonsensical. Obviously, currencies move for like all kinds of reasons. Dollar China is volatile. It went right back down sort of shortly after that high. Many other currencies that had no tariffs involved sort of retraced by just as much in emerging markets. Like, this is just like total nonsense. No evidence of any kind. Nobody agrees with him. Data doesn't agree with him. Research doesn't agree with him. Right? He's just pitching to Trump because he wants this job.
And I think actually the podcast that Steve Moran shared that on was my former podcast, Forward Guidance, with its new host. So shout out to Forward Guidance and Felix Javin. People can check that out. Ben, I think a lot of economists on the street might agree with you, and then they take that conclusion and then they say, because this tariff stuff doesn't make sense, the Trump administration is not going to do it. Do you agree with that? In other words, yeah, of course. I mean, the market's not going to decline because Trump is going to reach a deal. What do you think about that?
I think Trump has bought into this argument. I think that ultimately, like, Stephen Moran has achieved a position of prominence in the administration by telling Trump something he wants to hear. That's how you get a guy like Trump to promote you, right? This is sort of like, you look at the history of Trump's advisors, they kind of come and go very quickly if they disagree with him or if they tell him things he doesn't want to know, right? This is sort of how you work with a narcissist. And, at this point, I think, Trump has bought into it. Now Trump can change his mind quickly. And if markets are down 10 or 20%, over the course of a year, because we're sort of creating a huge mess in the global economy, he'll probably change his mind. Which, by the way, is another self-fulfilling reason why none of this makes sense. I mean, you hear proponents talk about, oh, we're going to do onshoring, we're really going to like rebuild American manufacturing. First of all, like, what company would make massive investments of hundreds of millions or billions of dollars, over like with a 10 or 20-year investment horizon, knowing that like Trump could just change his mind about this next month or next year, and does all the time, right? He changes his mind intraday. Anyway, and even if he didn't, like, the next administration will probably just undo whatever he does, right? So like, there's no like lasting permanent, even if you believe this kind of story that American businesses would want to reinvest and we'd move sweatshops back to the United States or something like that. The permanence, the belief that this is like a stable policy regime going forward is just not there from any circles that you look at.
Mm-hmm. And I also say, even if the long-term changes of tariffs were a good thing, I think there's a timing issue, which is if Ford and all these companies are going to reshore manufacturing, that takes 1, 2, 3, 4, 5 years, whereas the negative impacts of tariffs are going to be almost immediate.
Yeah, very much so.
Yeah. So Ben, how do you view this market when you have a risk? I mean, the various estimates of, okay, the tariffs, they could make real GDP go down by 30 basis points or as much as 1%. What is that going to be on Apple, Nike, Tesla, all these companies that makes things in China? How is that going to change the S&P earnings estimates for the S&P? Should the value, therefore, of the S&P go down? If Are you going to have, I guess, the multiple contraction as the earnings estimates go down, the price goes down more than the earnings estimates, and then in the volatility market, your world, are the volatility markets going to price in and kind of somewhat of an overreaction? So if earnings estimates only go down by 5%, the market goes down by 15%, and the volatility markets, volatility spikes way more than that. How are you sort of viewing this market right now?
Yeah, no, it's a great question. I mean, it's always tough to predict like how multiples are going to respond to, to fundamental impacts. But yes, there, if Trump goes through with, 25% broad-based tariffs on lots of countries, and if they retaliate and it goes to 50%, like, that's going to have big, meaningful impacts on earnings per share across, the S&P 500. It's going to, that'll take some time to kick in, and it's going to depend on a lot of different things, how big that impact is, right? I think the question about multiples is really, I think right now the market very much has still been discounting the idea that Trump is going to do anything that's really going to hurt the economy or really going to hurt companies, right? I think the market narrative is still really like tariffs are a negotiating tool. We don't really know exactly what he's going to do, but he's not going to really do this, right? And there are many other possible policy issues, deporting like 30 million Americans, or like lots of other kind of things that the market discounts heavily, like, okay, is Trump really going to do this? And once, I think, if one the key question is, like, say Trump were to come out and meaningfully do large scale broad based tariffs and stick with them for a while and not be reversing them, I think that makes the market go back and reassess all of the other kind of crazy stuff that Trump tweets about or talks about wanting to do, and saying, well, shit, like, he's demonstrated the willingness to actually go through with some of this stuff. Like, now what do we have to believe, and have to kind of re-rate beliefs higher on a lot of that stuff, right? And I think that's where you get potential impacts on multiples, where you get, potential volatility. The tariff story, I think, it could definitely create some pretty significant, headwinds for equity markets. It's not obvious to me that it, should lead to some giant messy short-term crash. Even though I think it will be a surprise the extent to which he goes through with tariffs. It won't be like all of a sudden. It'll be over some period of time. The market will be adjusting, right? It's not this sort of unknown that just hits the markets all of a sudden and sort of flips everybody's positioning. But I think that certainly it creates a lot of pressure. If you have, again, if you have pressure on earnings per share, and then you have pressure on re-rating, this idea that, like, look, Trump might actually do a lot of this crazy stuff that he talks about. Again, Trump is very much kind of a chaos agent, right? He's very much enjoying sort of upending the order of things, and that's not what businesses like, right? Businesses, tax cuts are great for, businesses like tax cuts, obviously, but much more so businesses like a stable policy environment where they know what they're dealing with and can make investment decisions. They can make hiring decisions without, feeling totally left out in the cold.
What is the positioning in the market? Is the market prepared for this in equity markets, but also the volatility market owning puts? If, let's say, the Trump tariffs are a economic car crash, I'm not saying they are, but let's just say that's the case. If everyone owns car insurance, and most people own a lot of S&P puts and calls on the VIX and the like, then they were very well prepared to generate income as the market falls and redeploy that into the stock market at lower prices. On the flip side, if no one owned puts and people are actually short volatility and short puts, you could have a market accident. Where on that spectrum would you say that the market is, and how is that informing your views on stocks and volatility?
Yeah, I'd say there's sort of somewhere in between. So, about a month or 6 weeks ago, hedge fund gross leverage and net leverage were pretty much at highs. Everybody was really long, everybody was really bullish, everybody had a lot of relative value risk on in the multi-strats. This drawdown in markets, and more importantly, the drawdown in kind of single stock positioning relative value trades within multi-strats, which was much harder hit than, the equity markets. You were seeing like 6 standard deviation losses in some of the multi-strats on like crowded popular equity positioning. Like, that took, some significant amount of the length out of the market and of gross leverage out of the market. So, like, we're still at modestly high levels, but we're not nearly where we were like 2 months ago. So that risk has come off a bit. And then when you look at derivatives markets, their hedge funds were doing a reasonable amount of hedging. Coming into a month or two ago, skew was steepening. The market was buying puts from dealers. So there was a lot of monetization of those trades as the market got down to, down 10 or 11%. Skew has come off pretty materially, but there isn't big crowded dangerous short vol positioning in the market. I mean, when you think about volatility positioning and volatility selling, there's kind of a few different categories. There's huge amounts of institutional call overwriting and cash secured put selling and those kind of strategies. Those are market stabilizing strategies because they supply, when a big pension fund via Neuberger Berman is selling call options to Wall Street, Wall Street's holding them, they're selling some of them to us, and we're having to dynamically hedge those positions. We're long gamma, we're long options that are at the front end of the curve, which means when the market's trying to go down, we have to buy. When the market's trying to go up, we have to sell. And that's like a market stabilizing force. The kind of dangerous vol selling is really like highly leveraged tail risk selling, right? So people selling like big size in far out of the money puts, people selling variance swaps, all that kind of stuff. And that, honestly, like, there's some of that, but it's much lighter than it was, say, coming into the pandemic in March of 2020 or something. A lot of the big crazy tail risk selling came out of the market, got blown up, and hasn't really been reestablished. Investors are still a little bit wary about that stuff. So I don't think you have the kind of either super high leverage in hedge funds right now, or the kind of very dangerous positioning in derivatives that you would need to get those kind of super crazy big crashes.
So there aren't that many folks who are short volatility in a dangerous way or short tail risk. And so you say the value of tail risk, the valuation of tail risk is roughly fair in your estimation.
Yeah, it's not nearly as cheap and it's not nearly as crowded of a sale as it would have been, 5 years ago coming into the pandemic, when there hadn't and where nothing bad had really happened, for the last 10 years. We had, again, the pandemic is slowly fading from memory, but it's only 4 or 5 years out, and institutional investors who lost 100% of their investment in Allianz Structured Alpha and Malachite and a bunch of these funds sort of remember that, right? And the market has a long enough memory to try to stay out of that. Prime brokers tightened up risk requirements, blowing up on Par Plus and a bunch of these other things, where ABN AMRO was letting tail risk slip through, on too highly levered basis. So yeah, we haven't had enough time, I think, in this cycle yet to build up that sort of super crazy dangerous tail risk selling.
So the stock S&P 500 is had a decline of 10%. We've retraced it 3%, so now we're down 7%. But single stocks have been down a lot more than the index. But what's been going on in volatility markets? Because I guess a 10% decline in a month or so is quite steep. Folks, comparing all the 10% sales back to 1929 and saying actually it is relatively quick on a 1 month basis. I guess a 20-day basis. But then tell us about the intraday moves, or I guess the 1 day moves have not been that extreme, right? It's been drip, 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 1% down, 1% up, 1.5% down, 1% down. It's not like down 6% or anything like that. Is Explain the nature of this drip, drip, drip market, and if there is continued bearish activity in the market and declines, do you kind of expect it to be this way and not definitely a March 2020 moment?
Yeah, that's right. I mean, what we've seen was a very low volatility, slow sell off. Again, 10% over a month is a reasonable drawdown, but I think the biggest day that we saw was around down 2%, and mostly it was sort of okay, down 1%, down 1.5%, down 2, sort of over and over and over again to get us down 10. Realized volatility on like a 5 and 10 day basis didn't get much above 20. It was like 22 or 23, right? And 1 month never even got to 20. So this is like a pretty low volatility event. As a result, you didn't see any kind of meaningful big spike in implied volatility or VIX. I think VIX very briefly hit like 29 and then came back off in a hurry. You just can't sustain really high option prices and really high implied volatility if the market's not really moving that much, right? We did see some bigger intraday swings, like the Trump tariff regime is a regime with more intraday volatility, right? Because we'll come in, he'll have tweeted something crazy about tariffs, we'll come in down 2% overnight in the futures, and then somebody will correct it or try to calm it down, and then it will rally back to flat, and you'll sort of miss that volatility. But even so, like, again, it's been relatively calm markets on the way down at the index level, right? Again, a lot of the real pain has been in these kind of leveraged factor trades and crowdedness within single name relative value positioning. And you've seen the really popular names like Nvidia, obviously on Deep Seek day was down, I think, 17% or something. You've had much bigger names in those, or much bigger moves in those really popular names. And that hasn't led to big index volatility spikes, because you can't hedge that position by buying S&P puts, right? It doesn't do anything for you if you're losing a lot of money because you're long Nvidia and short some value stock or something like that. It doesn't help you to hedge an index. Index isn't really moving, right? And so that pain didn't really feed through into index nearly as much.
And so if you could go back in time, 3 months or so, it would have been maybe a good trade to sell index volatility and buy single stock volatility, because the S&P is not doing that much, whereas Nvidia is down 70% in a day.
Depends on your timing a lot. So 1 month ago, that really wouldn't have worked, and the reason was, so that's like a correlation or a dispersion trade is what we call in equity derivatives, when you're buying like a basket of single name volatilities and selling index volatility. So yes, we realized a much higher volatility event in single names than index, but that's not new. That's been a theme kind of all year, really the last few years, and positioning in those kind of dispersion trades got extremely crowded to the point where the relative price of single name volatility as compared to index was like at record highs. You were having to pay a huge amount of money to buy those single name vols against index vol. And a month ago, again, we were at those extreme wides. Now we've kind of contracted back in, from a spread of maybe 17 or 18 points over at the 3 month point down to maybe 13 points. So we've cheapened that dispersion spread. People who were trading dispersion have lost money because they were buying it at such expensive levels. So yes, single names have moved a lot more than index, but like that was priced in, and actually it was like way too priced in because way too many tourists were involved in that trade.
And how are you estimating the risk and reward of a trade where you're short delta and short volatility at the same time? So you might, short VIX futures and short the S&P at the same time. So that type of trade would do quite well in over the past month, where the stock market goes down, but volatility doesn't go up that much because it is a contained market. Like I have not implemented that trade, but so I don't really know it, but just casually observing the market activity every day, it seems like that trade would have done quite well and did
Yeah,
quite
so
well in 2022 as well.
yeah, so we dynamically manage exactly that kind of risk. So we'll take volatility risk against delta risk, and yeah, sort of as the market bled downward, generally volatility didn't quite keep up with the short delta move. So you would have outperformed somewhat on that. Actually, in the rally back has kind of been the opposite, where vol hasn't come down as much relative to how much the market's rallied back. So you've sort of just had a low. We call that spot vol beta, or the kind of the beta of implied vol as a function of how the S&P is moving. Generally, you've just been in a relatively unsensitive regime, both on the way down and the way up there.
Ben, so I think when people say, it's been a drip market, and the 1 day moves have not been that big, but because it's been down 1% on Monday, down 1% on Tuesday, down 1% on Wednesday, you compound that on probably a 1 month basis. It has been a big move. Is there any way to sort of profit from the volatility? That if instead of measuring volatility on a 1 day basis, you just actually did measure it on a 20-day basis, not like 20 days of 1 day, but
Yeah,
actually on a 20-day basis, it is quite extreme, because it seems like all or most option prices is based off of 1 day pricing, and then I know there's intraday, but like if you owned like a longer term option, is that reflected the fact that like actually the 20-day move is quite extreme down, or somewhat extreme?
sure. Yeah, I mean, the way effectively, right, the way to express views or bet on longer horizon volatility in that sense is to own, be long or short options and not dynamically hedge them, right? So, like, if you say you bought a straddle and then you only rehedge that once a month, or you didn't rehedge it at all, right? Then you benefit from this trend effect, right, where markets are trending down, they're trending down. You're not rehedging, you're picking up short delta, on your straddle on the way down, and then benefiting from the fact that even though realized volatility on a daily basis wasn't that high, the end to end move was pretty high. And then conversely, if you had that kind of a trade and you weren't hedging it, you would lose in the scenario where you had like a lot of choppy mean reverting volatility, right? So like the S&P was really volatile on a day to day basis, but you just didn't move that far from your strike because you sold off and then you rallied and you sold off. So like that kind of unhedged straddle bet is a longer term volatility or longer term moves bet.
Mhm. And so there could be a bubble in the short volatility trade. There could be a bubble in the long volatility trade. Early on, you said you sound like there's not a bubble in the short volatility trade. Is there a bubble in the long volatility trade, like perhaps there was, after in the middle of 2020 and in 2021, where realized volatility was quite low, but implied volatility, people were just so scared, and they had one car, but they owned like 5 times the amount of car insurance that they had to have. Is there that is the market overhedged, or you think it's kind of neutral and in the middle?
I think it's pretty neutral. I mean, usually you get that dynamic where you get under hedging once it's been a long time since a crisis. You tend to get over hedging right after a crisis, which of course is exactly the opposite thing that you should be doing, right? And then we're sort of in the middle. We're sort of in the middle here. We've been 4 or 5 years really since any kind of meaningful equity market drawdown and volatility event. Investors are still somewhat wary of crazy leveraged crash selling, but they're back in dip buying mode. They're back in volatility spike selling mode. You had a lot of interest to sell every move higher in vol. And you certainly don't have massive, overwhelming, buying of volatility or tail risk hedging or anything like that. You see some interest in those kind of things. You did see hedge funds come out and do some tactical hedging as the sell off started, a month ago or so. But I think we're sort of in between there. We're very much neither in a short vol bubble or a long vol bubble.
Hmm. And tell us about the multi-strategy unwind, the so-called pod shops. They're very long momentum, very long certain single stocks. How much is your sense that that has been unwound, and is it likely to continue to impact market pricing in the near term?
Our sense is that move is relatively done for now, and that doesn't mean there won't be a second round later this year or anything. But what we saw was something like 6 standard deviation underperformance of that crowded hedge fund long short relative value equity risk. Not exclusively in the pod shops, but concentrated in the multi-strat pod shops. You saw pretty significant degrossing in those institutions. You saw various pods liquidated and fired. Those kind of institutions are very quick to kind of cut risk and cut capital and fire portfolio managers as they start to lose money as just a risk management metric. And then we've seen generally those moves and the volatility of those positions sort of stabilized this last week or so. So I think at least for now it seems like it's done. The certainly some of that positioning is still there, but I think the biggest impact has sort of played out. The VAR shock that another thing that you see with shops like that is as they start to lose a significant amount of money, their value at risk metrics go up. They start cutting risk in those pods, but also in other pods, sort of trying to keep a lid on things, and that has some spillover effects across markets on other crowded trades. We didn't, we've seen all of that pretty much stabilize at this point.
Mm. And so, in the early minutes of our conversation, it sounds like you're skeptical of the Trump trade strategy, and you think it could have deleterious effects on economics and markets. How, if at all, do you implement that view into your market positioning? You're not just trading your own money; you manage other people's money in your fund. So, how do you implement that, or do you say, I have this own view and personal conviction, but ultimately, like, I trust my quantitative process, and I'm not going to lean too heavily on that.
Yeah, so in the absolute return core of the business, we're market neutral all the time. It doesn't matter whether Ben is bullish or Ben is bearish. That's not sort of our job to sort of take directional risk. But certainly, our macro views and our views of positioning, affect how we think about risk and how we think about the possibility of squeezes or big moves in different types of positions. And like we're very serious about that across the portfolio and about knowing where we want to be positioned in terms of places where you could see big outsized moves. We also manage large tail risk hedges for institutions, and they're obviously by definition we're directional because those are positions designed to be complementary to their risk assets and do well when they fail. And yeah, making sure that we have positions there. One big question is path, and a lot of these questions that you're asking comes up, right? Because the types of hedges you might have for a big institutional investor, there are some types of hedges that might pay off very, very well in that big messy crash, that sort of pandemic style event, but that might not do very well in a slower grind down, right? In a 3 to 6 month equities down 20% kind of move, right? Because certain kinds of hedges might be, things where you're buying like a lot of shorter dated, deep out of the money downside, where you really need like that big move to make it work. We would be making sure that we're mixing in positions that will perform pretty well in that slower grind down, right? Because that's a very real risk case, right? That we have increasingly bad economic data coming in on the back and EPS coming in on the back of big tariff implementation, and it's not necessarily a big crash, but it's 6 months or a year of like sustained downside, and you have to make sure that those kind of portfolios can do reasonably well in those paths also, if they're because that's going to hurt generally the risk asset portfolio that asset owners own. They don't usually care that much if the equity market is down 20% over a month or over a year. It hurts them more or less the same. And so you need to make sure that a hedge portfolio can do well in either of those scenarios.
Why is it that a 1 month drawdown of 20% hurts just as much as a 1 year? I would have thought that 1 month hurts way more because it's happened so much faster.
Oh, I mean, it's psychologically harder, but the amount of money lost is the same. I
Yeah.
just mean it's not like the typical, your typical asset owner like has a linear portfolio, right? They own equities, I mean, and maybe some negatively convex, but they own equities, they own real estate, they own things that will participate to the upside and to the downside. They're, typical asset owner isn't like short a whole bunch of variance or
Mhm.
variance swaps or something like that, right? But like, you could imagine if you're doing like skew trades where you're selling a little bit of volatility locally and buying a whole lot more deep out of the money volatility on a very short dated basis, like that trade might do really well in a month where equities are down 20%, make a ton of money. It might actually lose money if you had a 6 month equities down 20% event, because it just doesn't go down enough in any given month to really monetize. And you just keep kind of rolling down and down and down into this, money losing grind. So like with the way that you structure a derivatives portfolio, the path is really important.
What are some opportunities you're seeing in volatility markets that are caused by phenomena of people selling too much volatility here or buying too much here? What are the various disturbances that you're trying to identify?
So, a couple of themes are really big right now and have been for the last couple of years. So, first of all, structured notes are a very big part of the equity derivatives world. That's where high net worth investors, especially, get get pitched notes from banks where typically they would get some kind of coupon, maybe 10% or 20% annual coupon on their investment, as long as some underlying basket of stocks is not down more than say 40% or 50% or something. It might be a worst of basket of Nvidia and Tesla and Palantir and some of these other retail favorites, where if any one of those stocks is down 40%, then instead of getting your coupon, you get wiped out and you lose 40% on your investment, right? Very simple example. They get very complicated, but so a note like that, that's basically the investor is selling long-term crash risk in stocks in order to get a coupon, right? So they're selling volatility. And the effect of that, of course, the dealer issues those notes. The dealer goes out and hedges by selling long-term puts, or variance swaps or something, and that depresses, long-term volatility and skew, in those names. Also an index, because a lot of those notes are linked to index. So if you look right now at long dated downside in those kind of names, it's very depressed. So firms like us will be looking to take advantage of that and probably hedging those types of positions with other types of volatility on the same underliers to express this kind of like explosive downside presented by that cheap vol. Another big dislocation is that for many years now, if you look at relatively short-term options, call it like 1 month, 25 delta calls at the money, 25 delta puts, that those options are overwhelmingly sold by large institutional income type of programs, vol selling type of programs, and that steepens volatility term structures and makes short-dated options relatively cheap compared to more medium-term options. And so inevitably, Wall Street warehouses a lot of that risk. Firms like us end up warehousing a lot of that risk. It has to go somewhere. So the end users are all sellers and the buyers are all, sophisticated firms that are buying it because the price is too low and, hedging it in various ways with something else.
And do you think those structured notes that banks are selling to investors, do you think that they are a sound investment product?
I think that the main drawback as an individual investor is they come with a lot of fees, some of which are observed and some which aren't. That's why banks love them, right? So generally, the trading desk is issuing them and getting a nice vig. Usually, the salesperson is getting a nice commission. Usually, the financial advisor who's then pitching that note to their clients is getting a nice coupon. So all that kind of comes out of your pocket as an investor. Beyond that, they're kind of long-term volatility selling. You should make money over time. A lot of people like that profile, the type of it. Lots of people ask me about these because they get pitched them, right? And, they say, look, I don't really know if Palantir is going to double again, but I don't think it's going down 50% and I can get this good coupon. And, they like that profile. And, fair enough. Like that's their choice on the risk reward of the product. My main point to them is usually just the level of fees that are involved kind of across all the different people who are getting a cut of it.
Okay, your comment is not as negative as I would have expected, because I think you're kind of on the other side of the trade. Like these structured notes who investors are buying, they're basically selling puts on a basket of securities, and you're kind of buying those puts. So you said they will make money over time, but does that mean when you buy these puts, you expect to lose money over time? You just maybe expect to lose less than your hedges,
Well, in an
or sorry,
absolute
you expect to make more with your hedges that you're short. Yeah.
the difference is absolute return versus outright investing, right? So you can think in an absolute return strategy, you're trying to buy something that's relatively cheap and hedge it with something else that's more expensive and make money over time, right? If you're doing kind of outright long-term investing, ideally you would be buying something that's relatively cheap, but you're not trying to hedge it. You're not trying to be market neutral. You're trying to get paid to take risk and have a risk premium. And over time, generally speaking, generally speaking, sellers of volatility and buyers of equity will make some amount of money over time, over long periods of time, because that's how the market compensates you for taking risk, right? And so, long-term investing is a different type of phenomenon, right, than sort of absolute return trading, where you're, picking related things that have different levels of cheapness and trying to create hedge trade structures and everything.
And these, the basket of stocks, are they typically like the Mag 7 or the big stocks that everyone would know?
Yeah, they're usually the popular names that vary, because ultimately Wall Street is trying to sell these, right? And people love Palantir. They love all, whatever the favorite basket of exciting stocks is, the Mag 7 and the favorite AI stocks and all that. That's what you're going to see in those baskets.
And what is kind of the time horizon where the volatility gets to be cheap? Yeah, like at what point does the options that people are selling expire?
Yep. So these are long-term structured notes. They have a weighted average life that's kind of complicated and depends on the note, but you could think of like 2 or 3 years. So pretty relatively long dated in terms of the options that are available on the screen. If you go to look at options, it's going to be like the longest dated leaps that you can buy.
Okay, very long dated. Okay, and so what do you make of these? Not these structured notes, but the double levered, some instances triple levered ETFs. I think on the index they've been around for a while, but now you have single stock ETFs. So double 2x leverage the price exposure to the daily moves of Apple or Nvidia. What do you make of these products?
Yep. So obviously, investors love leverage. We know that. We see that in lots of markets and in lots of ways. It is a cheaper way to get leverage typically for a retail investor than paying margin rates, because you're getting institutional financing rates through the ETF. When you get leverage through an ETF, you get it in a very particular way. It's different than borrowing money to buy 3 times your market value in Tesla, right? Because that ETF, it effectively limits its own loss on the way down, right? You can't lose if you buy Tesla triple levered, you could lose all your money on only a certain size move. On that Tesla triple levered ETF, it's going to be selling exposure as Tesla goes down, and sort of you have this convex exposure, right? On the way up, it's going to be buying more Tesla, and you're going to be making more and more. That introduces a really important effect, right? This sort of momentum versus mean reversion effect. When you buy a triple levered ETF, you get long kind of a momentum factor. You really like it if Tesla just trends up, 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 right? Because then you're getting more exposure, you're buying more, it's going up. What you really don't like is a mean reverting or negative autocorrelation environment, right? Where Tesla goes up a lot today and down a lot tomorrow, because then you're buying high and selling low over and over and over again and experiencing a lot of, this variance drag effect. And I think your typical investor in those products probably doesn't think about that or doesn't understand that, right? So they don't really get why, say, for example, Tesla ends up 40% over a year, but they didn't make 3 times that much, right? Because they experienced this volatility drag. Then the other important thing to keep in mind with these things is that they create a kind of a gamma effect on the close, right? Because they have to do those rebalances that we were talking about. If there's a really big Tesla 3x ETF and Tesla's up 10% on the day, that ETF is going to have to buy a whole lot of Tesla stock on the close to rebalance its exposure. And that creates this trendy move in the stock at the end of the day.
Okay, and how big are these products relative to these stocks? I'm looking at the Nvidia double levered ETF is about 4 billion, but it only 4.5 billion. But in comparison to a multi-trillion-dollar stock of Nvidia, maybe that's not that much. Is it really exerting a force that ultimately it could move the stock? You said it, maybe from that 3:30 to 4 p.m. time horizon, but elsewhere, like how much how much of the stock price moves can it be responsible for?
Yep. I think in most of the single stocks that have these double and triple levered ETFs, they're not yet sort of hugely outsized relative to the liquidity of the stock and relative to the market cap of the stock. So there's probably, some incremental impact on the close, but not major. But the important thing to remember also is it really depends on the liquidity environment and volumes, right? So I could be saying, look, there's not that much of an impact in this market where liquidity's kind of been okay and market hasn't been that volatile. But you get into like a pandemic type of situation where there's really a lot of volatility and market makers are very shy and liquidity is really drying up, and the price impact of like those size of rebalances suddenly becomes 5 times bigger or 10 times bigger, right? And you saw that a lot in the pandemic, including in equity index. For other reasons, where you had big rebalances on the close, you had very large market on close orders in the S&P during the pandemic, that just blew through all liquidity, and you would have days where the market was down 8% coming into the close, and then was ended up down 12% because of these rebalances just into no liquidity. So you really have to think about the liquidity environment when you assess like how much can these products really affect the underlying. I think again you get into a crisis mode, and like those liquidity impacts go way 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 up.
And these products are quite big now. So if the liquidity disappears, could you see it like being a March 2020 scenario, even though the liquidity right now is still there?
Yeah, I mean, very much so. The kinds of impacts these cause on markets during stress periods are quite large, and some of the in some of the cases, like take MSTR for example, there the levered ETFs are very sketchy because the banks that would typically give the issuer of these ETFs leverage on swap to execute these positions, the underlying is too risky, right? Nobody's going to give you 2x or 3x leverage on MSTR. So those issuers have to go out and buy call options in order to get the leverage synthetically that they need to implement their risk targets, and they end up owning a very significant portion of the strikes and maturities that they're targeting. These are very very big option positions to get that much delta in MSTR, for example. And if you get into a stress market environment, they'll have an incredibly difficult time like rolling and managing those option positions, because no dealer is going to show up and make a good market for 2/3 of the Nvidia option market, or the two-thirds of the MSTR option market sort of all at once. So I think we're yet to sort of test how those kinds of products can really function in a stressed market environment. I think it's going to be a huge mess.
And is there anything else in ETF land that new products that are could also be of interest or relevance?
Yeah, there's generally been huge growth in derivatives using ETFs over the last several years, right? So, like, certainly ETFs with crazy underlyings that need call options, that's a new dynamic. There's a big new dynamic in buffer ETFs, which are typically equity index ETFs that are effectively giving the owner like an equity exposure with a put spread collar overlay. Those have gotten very, very big, and very crowded and very kind of benchmark oriented, all doing very much the same thing. So typically selling a call to finance a put spread on top of an equity exposure, and creating very congested roles on the size of these products. The JP Morgan product that everybody talks about is an example of that. It's not a buffer ETF; it's in a mutual fund format, but it's the same kind of thing where those products are really proliferating. And as you know, with the JP Morgan one, everybody is always talking about it, right? It's rolling in 5 days. We have March 31st is expiration, so like we're getting very close to expiration on these humongous positions that create a lot of odd market dynamics. They create a really big role that everybody knows exactly what it's going to be, and so everybody front runs it, and they get very bad pricing and very big market impact. Again, much worse in crisis market environments than now. But yeah, the growth of these kind of products has just been massive. Same with growth of kind of yield generation option selling products like JEPI, and the Wheel ETF, where again it's very popular to do option selling for income. There's a lot of people these days on YouTube or Instagram, option influencers telling you that you've got to sell options for income, and there's a lot of very big popular products for that growing and growing. So yeah, the space has gotten vastly bigger. The ability of investors to be effectively getting derivatives market access through ETFs.
Actually, I there are some YouTube people who advertise on the Monetary Matters YouTube channel option selling. I can't choose. So I think it has been big. And then how predictive do you think that is? Like, just because you're seeing a lot of ads and people are talking about it, does that necessarily mean that so many retail investors are actually short puts and short calls?
I think it has been a big trend. Yeah, I think what you saw. So first of all, retail option trading kind of exploded upwards in 2020 and 2021. I think many of us thought that that was going to be temporary and then reverse at least part of the way, because people would experience so many losses and kind of give up, right? What you ended up seeing was that growth rate tapered off. We stopped kind of going parabolic, but like those that like volumes among retail traders have kept growing at a moderate rate even since those big plateaus. So like big involvement of retail investors in options trading is very much still there. It's migrated though. The story in 2020 and 2021 was really aggressive meme stock speculation, right? GME and AMC and all the, BBY and all these kind of names, people buying big leveraged positions and short dated calls, very, very risky trades, right? Some people who were early to that and who were smart, like made a ton of money. Most people lost most of their money because if you're not used to trading options, you don't know how to think about risk and premium. It's very easy to just lose all your money, right? Because typically you buy a stock, even if it goes down 50%, you only lose half your money, right? If you buy some out of the money call options and you just put your whole account into it, just if the stock doesn't go up enough, you just like lose all of your money, right? So people, inexperienced traders, lost very quickly. But I think a lot of the negative experience in that sector, um, but that matched with, hey, now these guys have options accounts open at Robinhood or at Tasty Trade. They know how to click buttons, they know how to trade options, and they're in chats online and in discords with people talking about all this stuff. They stayed involved, and what they did was they migrated to option selling, right? So what was the problem? Why did you lose money? It was because you were buying options. Aha, the thing that's where you should have been selling them, right? And so I think a lot of those social media influencers and Tasty Trade brokerage, which is very focused on option selling, effectively was able to capitalize on that and then get people into option selling programs. And so you've seen a continued sustained rise in participation of retail in things like covered call writing and cash secured put selling and the wheel strategy and all this kind of stuff.
But didn't you say earlier that covered call writing and cash secured put selling actually can have a market flattening event because they sell it to you and you're I guess short game or long game. You explain, but
Yeah, totally. So they are market stabilizing. The key way to think about that is when somebody is buying an option and somebody's selling an option, what matters is who is the dynamic hedger. Are both sides hedging? Is one side hedging or is nobody hedging, right? In this case, it's people doing covered call selling. They're not dynamically hedging those positions, right? They just own the equity and they're just selling a call against it. They're selling it to Goldman Sachs, who's selling it to me, and we're dynamic hedgers, right? So the dynamic in the market is we're long those options, we're long gamma. Market's going down, I have to buy to get my risk back to flat because as market goes down, I get very short because I'm long gamma. And I'm stabilizing the market, buying, and so is Goldman, and so is Susquehanna, and so is every sort of big options account. Vice versa, if the market's rallying, we're all getting long, we all have to sell, and so that dynamic reduces realized volatility, pushes against price trends at least kind of locally, within some range of the strike prices of these typically short dated options that people are selling. So yeah, that's a kind of a market stabilizing effect.
what about if they're not cash secured puts and they're just selling naked puts and Nvidia goes down a ton and people just get wiped out? Are you saying that even in that scenario that would be market stabilizing?
So in the case where there's very leveraged selling of tails, typically what you'll have is there'll be some initial market stabilization because dynamic hedgers might own those puts and be rehedging them. But as you start to get down far enough and you have those type of traders start getting liquidated, right? Then those positions have to be force covered, right? And puts, and so now you have, okay, Nvidia has sold off 30%, vol is already rising, and now you're forcing the purchase of a ton of puts to cover and cover all the risk and liquidate all the risk of all these people who have interactive brokers accounts and are 10 to 1 leveraged or whatever, right? And so that's very destabilizing because you're taking a volatile market and a stock that's already down a lot and vol's already up a lot and you're forcing a ton of put buying, right? So that's kind of the difference is when you have like safe kind of option selling that's cash secured, that's secured by owning the underlying, that's unlevered, that can tend to be stabilizing. When you have aggressive leveraged tail risk selling, then that will tend to be destabilizing.
Okay, that makes sense. And how would you say that this volatility environment and what you see for the next few months is different than what we've had in the past?
I would say this environment, the environment recently that it feels most similar to so far is probably 2022, right? Where you had some popular tech stock positioning that was pretty stretched. You started to see that unwind. It wasn't really a high volatility index event. Implied volatility underperformed on the move. And then 2022, you saw kind of a full year of that with some back and forth, right? This felt a little bit like the beginning of that. If my view on Trump tariff plays out, I could see that continuing, right, and having the rest of the year be choppy downside, but not necessarily a massive volatility explosion. Lots of other things could happen that could turn it into more of a volatility event, right? But I think that um, manifestation of incremental downside from Trump being more serious about tariffs than people think is probably equity market downside with vol up some, but not a lot, right? So we'll see. You could have that kind of event. It's certainly very different than a 2020 or some previous market event where you had much nastier positioning, much bigger surprises that came faster, much bigger unwinds of those positioning, leading to big catastrophic explosions in the market. I mean, I don't think we've seen anything like that. Even in the single stock positioning, again, we talk about like how extreme these moves have been in single stock positioning and in the pod shops, but you have to keep in mind we're talking about losses at the big brand name shops of like 3 or 4% or something, right? They're very well risk managed. They tend to make double digits returns, and like, okay, so they had a 3 or 4% down month. Like, it's not, it's only unusual in that they don't tend to lose money, and so that's a relatively big loss for them. But again, this is not a catastrophic sort of market event, right?
I mean, I want to ask a question that's not necessarily for Ben, the vol trader, but just Ben, the macro pontificator, like everyone else. So again, people shouldn't say that just because what you're about to say doesn't mean that your positioning reflects that. But how would the distribution that you see over the next year of the S&P, a bell distribution, fat tail. Often, what is mispriced is the right tail. All the strategists go into on January 1. They say, I'm bearish, or it could be a 5% year, or and then in 2023, 30%, 28%, and it's always things can be way better than expected. What do you think now about that possibility that the market could actually just have another extremely big year? Based on what you're saying, it seems like it is slim. However, it to many people it often seems slim, and it happens more than people think.
Yeah, absolutely. I mean, you always have to have that possibility in mind. It's certainly not my base case. I think it's relatively low probability, but I think that the scenario path would be something like this, right? It's you suddenly see Trump um, shift rhetoric very significantly on tariffs, right? And saying, okay, we're gonna, people have been really good about this. I'm really getting the concessions that I wanted, like, so we're really going to be able to negotiate on this, and like, actually see him make credible, lasting, deals with relatively low tariffs that are sticky and sort of a significant vibe shift that demonstrates that he's not going to be doing this anymore, right? Sort of takes a lot of the risk off of the table, and then runs and goes through with a lot of the big tax cuts and deregulatory stuff that he's planning without sort of chasing up the more kind of populist nationalist type of rhetoric. Like, I think in that type of setting, like, yeah, you could definitely see material equity market upside, and prove a lot of people wrong, and that it's always a path that can happen, right? I mean, I think that multiples are already stretched, but uh, anybody who paints a really strong picture of near-term equity price action based on forward EPS is vastly overstating the statistical certainty that you get out of anything like that. Multiples can always go higher. Stock valuations can do kind of whatever they want, right? And so I think you always have to keep that kind of a scenario in mind for sure.
Absolutely on estimates, and people on TV 2 weeks ago said, I mean, estimates haven't even come down. It's like estimates have come down. Look at the market. The people at the banks, they have their, if the market goes down more, they'll lower their estimates.
Yeah.
It's totally made up. I guess Trump has a lot of on paper investments. Apple 500 billion, TSMC 100 billion investments in the United States that I think you do have to take with a massive grain of salt. But he could claim victory based on that.
Well, he will. Oh, he will. Trump always claims victory. That's the kind of the first thing you do is, regardless of what happened, you claim victory and you explain why you were victorious and why the other guy lost, and you make up sort of the facts and the reality as you go. Right. I mean, he's a reality TV guy. It's sort of totally his expertise.
And so that's what. So it sounds like you think the risk of a market crash is somewhat unlikely. Obviously, always possible, but it's not like the market is ripe for a market crash.
Yeah, I think generally to get a really big fast crash, right, you need some combination of really new surprises that are pretty meaningful and people didn't see coming, or at least were very dramatically underpricing, which I think you have some element of with tariffs, but I don't think a huge extent. And then you also typically need aggressive positioning. You need very long, you need a lot of leverage, net and gross, and it really helps to have really sketchy derivatives market positioning that will kind of amplify moves, kind of very risky leverage tail risk positioning that are going to blow up hedge funds and banks and things. You just don't really have that. So I think that the underlying conditions for a big, sudden, massive market crash aren't really there. Again, that doesn't mean you can't have some wildly unexpected event that drives it, but the kindling isn't really there to start a massive bonfire.
And Ben, a hallmark of the past month has been the U.S. stock market selling off as the European equity market goes up alongside the Chinese equity market. In the volatility world, what are you seeing on the options on China ETFs and European ETFs? How is the volatility risk premium and the pricing compared to the S&P?
Yeah, no, absolutely. You have, those markets are much more illiquid from a vol perspective, but you've definitely seen a lot of interest in upside in rest of world, which has been very out of favor, right? I mean, the last 10 years have been this massive US bull market and rotation of investor assets globally into US and especially US tech. That's been a huge theme. It's been part of a driver of why crises have been so US centric in the last 10 years. Like the pandemic was, even though the pandemic was global, US markets actually suffered the most from it because they were the most crowded and everybody was invested in the US. You've seen the first glimmers of a little bit of a rotation of that, right? And those kind of big thematic changes are something that big investors often really like to use derivatives and options to express, right? They haven't necessarily had time to go do a ton of work to pick their favorite 20 stocks that they want to invest in European defense. But they'll absolutely come in and lift banks on some big call spreads or calls in Chinese equities and European equity indices, and you've seen that start to happen. So you've had a little bit of a bid there on a relative basis.
That makes sense. Well, Ben, what would you say is the greatest misconception about volatility that you encounter, either on Twitter, in real life, with investors who are sophisticated in other markets, but maybe they make some mistakes in volatility?
Oh man, there's a lot of good ones. I would say one that immediately springs to mind is it's a very common heuristic for non-specialist investors that volatility is cheap if it's low and expensive if it's high or has gone up recently, and that's actually just very much not true if you look at data. So you can lose a lot of money buying volatility at a relatively low level because volatility is low because nothing's going on and the markets are really quiet and realized volatility is really low. On the flip side, actually, some of the probably the biggest money that we've ever made and many investors have ever made in derivatives markets is buying volatility after volatility has already gone up significantly, but everybody's trying to fade the spike and trying to sell it, and it actually hasn't gone up nearly enough given kind of what's going on in the world, right? So if you look empirically at let's say S&P vol is 10 or 20 versus 40 or 80, do I make more money selling it at 40 than I do at 10? The answer is no, right? There's actually almost no relationship, and that's very, very counterintuitive to a lot of people. Like everybody wants to think vol is high, it's expensive, vol is low, it's cheap. It's more complicated than that, right? Markets are not that dumb, right? Markets are not that simple.
So selling vol at 40 is not as profitable as selling vol at 10. Is there a higher a higher win ratio of selling it at 40? Because most of the time when it's at 40, it goes down to 20, but the handful of times it can go to 80. But if at 40, it really, I mean, the highest is what, 80? So that's, if you short it at 40, it goes to 80, just short more, right?
But keep in mind when you're shorting vol, so volatility markets already price in mean reversion, right? So everybody says like, oh, vol's mean reverting, it has to go down. Of course it does. Vol markets very literally price that. There's a term structure of vol that already says vol is mean reverting. You have to be more right than the term structure says, right? So like when short dated vol is at 80, 2-month vol is at 60, 3-month vol is at 40. And so if you're going to sell 3-month vol, like you're not selling it at 80, you're selling it at 40, right? And you need realized vol to be falling faster than the market's already implying. And that's kind of the thing. Like usually when 1 month implied vol is at 80, actually recent realized vol is probably 120. And if you sell it at 80 and like that realized vol persists for just a little while longer, you're getting your face ripped off, right? And if you sell, the VIX, that like my favorite, time, I talk about this a lot, was like at the end of February 2020. uh, Equity, pandemic was starting. Equity markets were down maybe 12%. The VIX had hit 40. Everybody says, oh my God, the VIX is 40. That's really high. You have to sell it. But the VIX index was 40. The front month VIX future expiring in like 12 days was at 26.
Mm.
Right? So people are saying, oh, I'm selling VIX at 40. No, you're not. You're selling VIX 12 days out at 26. So the vol has to collapse just for you to break even. Right. And that VIX future was actually like trading at below arbitrage boundaries with respect to the S&P and all this stuff because everybody was trying to sell it, and it was the worst trade on earth. You were supposed to, back up a truck and buy that thing and hedge it with other stuff. And again, you have this very steep roll up the curve because the market believes vol is going to go down so fast. So like, yes, absolutely, vol is mean reverting. Yes, absolutely, it will go down. The market already prices that. The question is, how much is that priced, and how fast is vol going to go down?
So what you look up as the VIX could be at 80, but what you actually can buy or short is the front month futures contract, and that's off at 80. I think an extreme example of that was August 5th of last year when the VIX you could look up on Google was high, but the VIX futures didn't go up that much. So I guess the actual VIX that you can't trade, the peak is, I mean, I don't, but like somewhere 80, 81, somewhere right there. What has been the peak in the actual tradable VIX, like the front month futures?
So in the pandemic, actually, the futures did go to like 85 or so. Very briefly, what happened was there were a lot of very large, many of all kinds, but there were several very large investors that were massively short the March calls on the VIX, and they got liquidated all at the same time in mid-March in an auction that sort of, in order to take down the sizes that they were short, blew those futures to 80 plus and took them to crazy, crazy levels relative to the S&P vol market. And then, people like us kind of had to come in and compress that premium and move everything back down. So they didn't stay at 80 plus for long, but they did get there.
And anytime you have a VIX spike that is, 80 level, 70 level, what you said about if the market's pricing it in, that means a backwardated curve. So the market is, short dated vol is more expensive than long dated vol. What's the highest level, like far out VIX futures have ever gotten? Because I actually looked at it today to prepare, and like in March of 2020, I saw, when the VIX was at 80 or something, the long dated contracts were like 35 or
Yeah, it
something.
was
Like,
mid 30s
yeah,
exactly.
yeah.
That has tended to be about the ceiling on that stuff. They also got into the 30s like in late 2011 with the U.S. Treasury debt downgrade and the European crisis and everything. And so that was that tends to be where things get to. But an important rule in derivatives markets is like, just because tail risk events don't happen very often, and they're all different, right? So you can't really make very hard conclusions based on 5 events of like exactly what the ceiling and some different variable is, right? I mean, oil went to negative $42 that one time. Like crazy stuff happens, and like you don't know how it's going to go next time. So like betting the house on like, well, this particular vol can't go above like this level is a really bad idea.
Mhm. What do you think? I know. I mean, you just said you can't say this, but like, at what level of VIX is it just like, wow, this is way too high, or like, or is there no level like VIX 120? Can
Yeah,
every level of VIX be justified by the move in the realized fall?
yeah, I mean, exactly. It really depends on realized vol, and generally, if VIX is at 120, it's probably because realized vol is 150, and like we're moving 10 or 15% a day, and like it really depends on what's happening. But like, the market is not is the market is relatively efficient as a starting point, right? That doesn't mean the market's always right about everything, but like as a starting point, like if VIX is at 120, it's probably for a damn good reason, and it's trying to sell variance swaps at 120. It really depends, but like, yes, you could still get your face ripped off because maybe the market's moving, much, much more than that. And, odds are, again, something really crazy has happened, and, you're being brave, and, you're more likely to not to make money probably. But like, it means that the world is truly insane. And there's probably a lot of justification behind those prices.
Mm. Ben, earlier I asked what is the most misinformed view on volatility outside of the world of volatility. What do you think is the most misinformed view in markets or economics right now?
I think this is already kind of starting to shift, but uh, I think there was I wouldn't say consensus, but there was like a plurality view that Trump is sort of pro business and pro markets, and I think that that's quite wrong. I think Trump is pro Trump, And in sometimes some ways that might align with being pro markets, but it's really not inherently the same thing at all, right? And depends on the political coalition and depends on the objectives. And I think now you've seen Trump launch a Solana meme coin out of a Delaware LLC. You've seen him on Twitter like pumping his meme coin, making billions of dollars. You've seen him install a crypto czar that announced a strategic crypto reserve that's going to be buying all of the coins that are in his personal like venture capital investments. Like, I mean, that's what sort of being self-interested does, right? You can just kind of loot the government and loot the country, and I think that's much more interesting to Trump than taking care of the needs of people or businesses or whatever, right? And I think that that's just going to continue to be more and more clear over the next 4 years. But like this idea that Trump is like a pro markets force, I think is quite backwards, and the markets are going to come to understand that over time.
Yeah, that's interesting. I think when he first got elected, you had a huge surge in small business optimism. I think you got to look at the political bias of people, because I think a lot of like small business owner is associated with the Republican Party. So of course it's not a sign that the economy just got way better. It's a sign that Republicans like the fact that a Republican just got elected.
Yeah, I think that's totally right.
Yep. Ben, thanks so much for coming on Monetary Matters. People can find you where you post often, a lot of great volatility threads, on Twitter at Benn P. Eifert. I am on Twitter at JackFarley96. People can find the show on YouTube. If you watch it there, please like and subscribe. I think something like 70% of people who watch our videos actually are not subscribed. So please do subscribe. And then also check us out on Apple Podcasts, Spotify, and other podcast apps. Thank you again, Ben, and thanks everyone for watching.
Awesome, Jack. That was a lot of fun. Thanks, man.
Thank you. Just close the door.